When it comes to retirement, one of the most common questions people have is, where should I pull funds from first? It's not always clear, especially when you're balancing a variety of accounts: IRAs, 401ks, and taxable brokerage accounts. The right strategy can make a huge difference in how long your savings last and how much you end up paying in taxes. Stick around because I'm about to share the best strategy for pulling funds in retirement, and by the end of this video, you'll have a clear understanding of how to make smart, tax-savvy decisions with your retirement funds. Before we dive in, if you're serious about protecting your wealth in the next 2 weeks, make sure to check out the first link in the description. Thousands of Americans are opening gold IRAs to protect their savings, and you'll get access to a free guide that can help you make a solid, informed decision about your retirement strategy. Now, let's get into the meat of this. When you retire, you'll have different sources of income, some tax-deferred, like your 401k or traditional IRA, and others already taxed, like a taxable brokerage account. The first step in deciding where to pull funds from is understanding the tax implications of each. Let's say you have a 401k or a traditional IRA. These accounts are tax-deferred, meaning you don't pay taxes on them until you withdraw the funds. But that also means you're paying taxes at the time of withdrawal, often at higher rates because you could be in a higher tax bracket. So, pulling from these accounts first might not be the most tax-efficient strategy, especially if you have other options available. A better strategy is to use your taxable brokerage account first. The funds in this account have already been taxed, so when you withdraw them, you're not going to be hit with another tax bill. Plus, by using your brokerage account early on, you can let the funds in your 401k or IRA continue to grow, tax-deferred, for as long as possible. But here's where things get interesting. What if you're not relying on a taxable brokerage account? What if you don't have one? Well, then you'll want to think about creating a tax strategy that works best for you. Ideally, you'll be drawing from a mix of taxable, tax-deferred, and tax-free accounts to balance your withdrawals. One of the best options for long-term wealth protection is a gold IRA. Let's say you've been saving in a traditional IRA or 401k, but you want to diversify your retirement assets. A gold IRA can help you protect your wealth against inflation and market volatility. Unlike stocks or bonds, gold holds its value over time, making it a great option to safeguard your savings. So, why not consider using a gold IRA as part of your strategy for pulling funds in retirement? You can make tax-free withdrawals if your gold IRA is set up properly. And with a gold IRA, you're not just saving for the short term. You're building a long-term strategy that can stand the test of time. If you're interested in learning more about this, don't forget to check out that free guide in the description. Now, let's talk about required minimum distributions, RMDs. Once you hit age 73, the IRS requires you to start taking distributions from your traditional IRA or 401k. This could force you to withdraw more than you want, pushing you into a higher tax bracket. If you've been using your taxable brokerage account effectively, your RMDs won't be such a big deal, and you can use those funds to reinvest in your portfolio or make up for any shortfalls in your retirement income. In conclusion, the key to pulling funds from your retirement accounts is balancing tax efficiency with your income needs. Use your taxable brokerage accounts first, then move on to tax-deferred accounts, and finally, consider diversifying with a gold IRA to protect your wealth long-term. If you've got at least 100k or more in your IRA or 401k or even 5M plus in savings, this strategy is perfect for you. Click the link in the description to get your free guide and start protecting your wealth with a gold IRA today.